Hey, what is going on? It is Aaron Trevino here, and we have David Dominguez on today. David works here in the city of Austin. He works in finance, and he's a real brilliant guy, real bright guy, and he has a lot to share with us today. So, David, could you tell us a bit about yourself?
Absolutely. Thank you, Aaron. As Aaron mentioned, I work here in the Austin, Texas area. I'm a Central Texas guy. I've grown up here, born in San Antonio, raised in Taylor, Hutto, Round Rock, Austin. So been around. The best years of my life have always been in Texas, and I've always said that Texas is kind of like gravity. Anytime you try and leave, it pulls you back. Found a job in finance after college, and have been working here in the financial services industry for about 5 years, which has left me here at this company called Equitable. And so we're a very large financial services firm. We were founded in 1859. So we've been through two world wars and a Great Depression, and at this point, a global pandemic as we speak. So still going strong. The main thing I wanted to speak about today is income tax mitigation. So there's a unique strategy that I was speaking with Aaron about, and feel like it's great to share with those who may be interested in lowering their income tax burden, especially at the top end. I think that people underestimate how much of a factor that taxes are when it comes to growing your wealth. And the main reason why is because people just kind of accept, oh, I got to pay taxes. There's no way around that. And that's true, right? Like, I mean, at some point, no matter how much we get it lowered, you got to pay taxes. But you do have some options, and you have some options on when you're going to pay taxes, and you have a great many tools that you can use to actually lower that income tax rate. And it could be so large, in fact, that it could be even more. The amount you lower it by could be greater than the amount that you're gaining on your interest on your other accounts. So it can be a great boon to grow your wealth. It can be a great strategy just to keep in mind if you're not there yet in the future as someplace that you want to be. But yeah, let me jump right into it. So. Alrighty. Aaron, can you see my screen now?
I sure can.
Alrighty. We'll hop right in. So this particular strategy is something that we're going to call the three bucket strategy. And I would like you to think of buckets as income streams. So there are three different buckets to think about. There's your pre-tax bucket. So you've got pre-tax contributions, tax-deferred growth. So these examples here, like your traditional IRAs, your pension plans that you have, and maybe your like government jobs. A lot of older employers will still have pension plans functioning. Your 457 for your government jobs, your 403Bs for your nonprofits, your churches, your schools, and then your excuse me. But then also your small business owners, your sole proprietors, your SEP IRAs, your simple IRAs. So benefits are you get a tax write-off. Cons are you can't touch it until you're 59 and a half years old. The next income stream is your after-tax bucket. So these are, this is your real estate investments, your brokerage accounts, your Robinhoods, your E-Trades, things you maybe have at Edward Jones, things like that. This is your stock plans, things like that. Restricted stock units are in that. And I'll even speak a little bit further on the restricted stock unit piece as we move down the line. But the great advantage of this is, you already paid the taxes on it, right? So your Uncle Sam is not going to tax you on the same dollar twice. So the disadvantage of it is that it's just kind of there from this point on, because it's liquid and it's out there. The growth on this is as it grows and it accrues capital, it's going to get taxed. It's going to be taxed at that capital gains rate. So your third income stream is your tax-free bucket. So these are your Roth accounts, backdoor IRAs, your 529 plans, so things for education basis for your children, your HSAs, and these are becoming more and more popular these days for apologies for that, for health spending accounts. The great advantage about this is that even though you can't touch the growth on these until after 59 and a half, you can touch your cost basis. So again, it's not the same dollar twice. So whatever you paid into this, you're always going to be able to pull out after a certain amount of time. I believe it's just a few years. It has to sit in there for you to be able to pull it out without any type of penalty. So the disadvantage of this is twofold. One, there's of course still that 59.5 rule to where you can't pull out your growth. The other disadvantage of this is that there are cap rates, and what I mean by that is that like if you make above a certain income threshold, you're not going to be able to access some of these, such as your traditional Roth accounts. Now, there's a great unique way, and this is kind of a little bit of a segue here, so I'll say this quickly. Look, cash value life insurance gets a bad name out there. A lot of people don't like it. Like Dave Ramsey is probably the most vocal critic. But that being said, cash value life insurance works the exact same way as a Roth IRA does, but it doesn't have the income limits. So if you find yourself above the Roth contribution limit, the only way you're going to be able to get that same advantage is cash value life insurance. So just a quick aside. But anyway, so the advantage of this, of the three income streams, is that if we balance buckets or income streams 1, 2, and 3 in a certain way, we can reduce our tax consequences. And how do we do that? So the best way to think of it is not all taxes created equal, right? So capital gains and dividend tax rates for 2019 are as follows. So if you're at the 0% tax bracket, so income rates in retirement, the more you withdraw from bucket 1, you're between 10 and 37%. So your capital gains, however, are going to be taxed at 0% if you're in the 12% and below bucket, 15% if you're in the 22 to 35% income tax bracket, and only as much as 20% if you're in the 17% income tax bracket. And I realize these are kind of a lot of staggered numbers. So what does that really mean? So if we're staying below this number right here, out of the terms of bucket 1, right? And so for married, filing, and jointly, the 12% bracket cap is $78,950. So if you take the standard deduction, then you're going to get into the 12% tax bracket, and so that is the 28,700. The standard deduction is 12,200. So that means that if you're going to balance, and this is the bucket I want here. So if you're at 40,000 here and 40,000 here and 40,000 here, then you're not going to get taxed on this bucket. You're not going to get taxed on this bucket at all either, because your income never touches that first number right there. So the best way to think of it here, there's a nice little slide here. So if you're staying in bucket 1 here, you're at 40,000. Sorry, keep trying to click and I forget that I don't have my my clicker here. So if you're at 40,000 here, then you take your standard deduction. Then the only income visible is $15,800. So your federal tax on that is $1,580. And because of that, because you're still in that 12% bracket total, then buckets 2 and 3 don't matter. They're at 0%. So you can pull as much money as you want out of those, and they're at 0%. So you can see how it scales. You can see that I'm not trying to pull a fast one on the IRS here. This is from the IRS website, irs.gov. You can see the married, filing, jointly rates and the standard deductions here. And a slide I skipped over a little bit earlier is this one right here, because this is the goal, right? This is the standard by which we built this strategy, is that $120,000 worth of income can receive this tax bracket rate right here, or this amount of estimated tax value. So that's effectively a 1.3% rate. So if you're jumping from the 35% rate down to the 1.3% rate, you're talking an incredible amount of savings. It's over 33%, and that's every year. So when is the last time that the market average or your market returns averaged, 33% year after year after year? And this is completely legal. It's solid. It's effective. It's not going to change until there's a legislative tax law. So I would say it's important to make sure that your portfolio is diversified, just like it's important to make sure that your tax time frames and your taxable accounts are diversified. So I know that was a lot of numbers. I'll pause for a second. What questions do you have?
Yeah, so I think that one thing that people would generally want to have a little bit more of an explanation on would probably be slides 6 and 7. being that, that was where you were going into explaining income taxes. If you could just kind of break that down a bit, maybe someone, is not exactly familiar with these different, with these different types of rates, or even what capital gains or dividend taxes are. So could you further explain this slide?
Absolutely. So your income tax rates in retirement, the more you take from bucket one. So let's say that in bucket one, all of your tax deferred accounts, let's say that let's go back 40 years. Somebody who retires in the 80s, they've stashed money upon money upon money into to all different types of bonds, into all different types of stocks in their companies, and they retire way back then, and all that they're going to live off of then is all of their tax-free money. Well, now then, because they have such a large amount of wealth, let's say they were a middle income family that they retired back then, because they have such a large amount of wealth that they're taking all at once, all that value gets counted on your taxes. So that actually bumps your income tax rate up. So even though we live in a progressive tax system, so you're taxed on the last dollar spent, or the last dollar earned, I'm sorry. So because of that, you're taxed on the last dollar. If you just made all of these dollars at this rate, then that's the rate you're going to be taxed at. It doesn't matter that, there's a finite amount to it, unlike a job where you're going to keep getting an income stream. That your total wealth is measured, and so now then you're in the next tax bracket. And that's an unfavorable situation to be in, especially in retirement. So you might have been in the 12% tax bracket, and you retire, and then you take all this money all at once, and now Uncle Sam says, well, now then, because you have all this money, you're in the next bracket up. Because you're in the next bracket up, you're going to continue to get taxed on that amount. So this is a unique way where it says if you stay below, because slides 6 and 7. So this is slide 7. So if you stay below this number right here, so this is for married, finally, and jointly. The top of the 12% bracket, which is the lower bracket, is $78,950. Now this is 2019. So you can take the standard deduction, which is 24,000. The single filing top of the tax bracket is 38,700. So it's half of this. And then the standard deduction is $12,200. So it just depends on how you're filing your taxes. But either way, let's say that this is for married, filing jointly, or this is about that $40,000 number. So that's why this slide exists. So we're trying to keep the income coming out of bucket one at this 12%, this first income bracket. Because then our capital gains and our dividend rates are 0%. And if they're 0%, then as they grow, companies, for those who don't know what dividends are, occasionally a company that you have a stock position in will say they're not required to, but they may give you money and you can choose to reinvest those or take it as cash. Either way, the gains and the dividends, as long as the money coming to that first bucket is still below that number, 38,000. For 38,700 for a single person, or 38,700 for a single person, or 78,750 for married. Then, and you take your standard deduction, you're going to be below that 12% bracket, and your gains and your dividends are going to be taxed at 0%. It's phantom income, essentially. That's a good way to think of it.
Okay, could you kind of roll that back to what phantom income would be?
So that would be your gains on your buckets 2 and 3. So if we're looking at buckets 2 and 3, so your capital gains. So when you have an Amazon stock or a collection of Amazon, Facebook, Google, Alphabet Inc., the gains on that money, let's say that you bought in at $500. They're $1,000 now. Your gains are 0%. Your money market accounts, so those are things like your banks. They don't issue them anymore, but if grandma and grandpa ever bought you a bond when you were a kid, gave it to you for your birthday, and then you're going to cash it in. Your money market stuff, those are 0%. Your real estate income, 0%. Some employer stock plans. So Amazon is in a unique position in that if you work at Amazon, no matter how high up the chain you are, your income is capped. Like, you will never make more money in cash through your paycheck than a certain amount. What you will get is a schedule of restricted stock units. So that's what would fall under employer stock plans. And then, of course, your Roth account. So you put in $2 every year for 30 years into your Roth account. And so you have $60 at the end of those 30 years. This is a really low number example, but this is just an example. Let's say that it gains another $60. So then you've only ever paid the taxes on the $60 the first time. The next $60 is tax free. You're not going to be hit with a penalty for it, or you're not going to be hit with a tax rate for it. Penalty is the wrong word.
Okay. So, understood. Also, I'm looking here in the middle at bucket 2. I see brokerage accounts and then real estate. When you say real estate, do you mean, would that count for someone who maybe owns a rental property, owns a duplex, an apartment complex, or just a personal home?
So your real estate would be the valuation of the properties you own. Now, if you're getting money from like a continued check from tenants per se, that's a different tax situation.
Okay, understood.
So, and there's different, Sam sees different tax implications for when you're actually have multiple properties by which you house others. So this has to go with the valuation of the property itself.
Okay, very good.
Yep.
Absolutely. And then could you go to the next slide, slide 10?
Sure.
So could you explain the differences between slides 9 and 10? Because I see, the same buckets, the pre-tax, after-tax, and the tax-free. But could you kind of further explain the differences between the two tables here?
So this is an example of balancing the buckets out. So the only thing that changes here is just, you'll see underneath the buckets, it's just listed what types of things are in them. And then when we go to the next bucket, we're seeing numbers assigned. So if you have 40,000, 40,000, and 40,000 spread throughout the buckets through your lifetime, and then at a certain point, you're like, you know what, I'm ready to start just taking, and this is annualized. So this isn't total. Of course, you're going to need more than $120,000 in retirement. But if you're, taking 40,000 out of these each annually, you're looking at only paying taxes on $1,580.
Fair enough.
So, or it would be a roughly twice that number if you're married filing jointly.
Okay, yeah, that's a heck of a bit of savings. So if I could just ask you this, why do most people not know of anything like this? Because on the surface, if I were to see, if your income's 120K and you're talking about paying, $1,600, it almost sounds too good to be true.
I think a lot of times, for one thing, the economy has changed in the way that people are taking income. There are a lot more tools that make it easier for people to reach this type of goal. Especially, I mentioned my example, let's say somebody 40 years ago, they didn't have anywhere near the amount of financial tools that would have allowed them to pull this off back then. It would have been, just like, oh, okay, well, now then you retired, here's all your money. A lot of times as well, and you see them less and less now, but defined benefit plans used to be much more prevalent in society. And because of that, like I said, the economy's changed. Now then people don't work at the same job really for 40 years at a time. But, let's say that you rewind the clock back. You would have somebody, Joe Smith works for company A for 40 years, and company A has a defined benefit plan for him. At the end of those 40 years, Joe Smith gets the benefit. It's not that he's, it's not that it had to grow in the market. It's not that whatever happened in the market happened in the market. Joe Smith is guaranteed his benefit. It's a defined benefit that he's going to get for the rest of his life. And that's why it hurts so much, way back when companies would crash. It's because people were counting on that. Now then all the money's gone. It's like you got to restart from scratch. So that's why now then you see more and more people are doing defined contribution plans like 401ks, is because it's not as reliant on the company's solvency. And so really the tools have changed. I think advisors have become a lot more aware of how much opportunity there is to bring this kind of knowledge to people who otherwise wouldn't have access to it, which is kind of what brings me here. I think that there's a great many people that can benefit from this. There's a lot more startups, small businesses, sole proprietors. A lot of people have side businesses or more than one job at a time now, and so this is something that is more relevant than it used to be.
Absolutely. It's such a vast area, and frankly, it's one of those things that a lot of times people don't plan for it. They don't want to talk about it. They have sort of a half-baked plan. But one concern that I see from people, especially the younger generation who aren't even close to retirement age, who are just getting started. A lot of times they'll say something along the lines of, "There's no sense in planning because retirement is too far away," or "the system is too complex," or "Social Security will eventually run out," or you mentioned how we don't work at Ford Motor Company for 40 years. Someone could be at a company for 1, 2, 5, 7 years, nowhere close to 40. How would you suggest someone just getting off the ground to even take their first step into proper financial planning?
I would say take an inventory of where you want to be, and I don't mean I mean dream a little bit too. I think that a lot of people will be like, "Oh, realistically, I can't do this." And we as humans, everybody, you, me, everybody, has a tendency to base the capability of something being done off of our ability to do it, rather than can it be done. And I think that that's been the great fault of a lot of people. And so I would say, and I'm not trying to put somebody down, but let's say that you're excellent at running your business. You're excellent at running your personal training business. You can whip somebody into great shape, but you just have no idea about numbers. And it's like, okay, well, maybe you're really efficient in this lane. Why don't you talk to somebody who's really efficient with understanding finances and numbers? And maybe there's something that you never heard about. Maybe there's a particular product or service that might be able to do what you think can't be done just because you didn't hear about it.
Sure, absolutely. It's definitely important to have that sort of self-awareness of knowing, where you are now, and taking steps into where you want to be in the future. So that's definitely something really important to consider.
Absolutely. So, absolutely. One other thing too, while I still have this slide up, or I should say the previous one, and I said I was going to revisit it, but I didn't. For those of you listening who may have this particular restricted stock unit, sometimes it's called a restricted stock option. One other slide aside, I wanted to mention, just like I did with the cash value life insurance, with a restricted stock unit, you have the unique ability to where you can pay the income tax at grant rather than at vest. And depending on your company, that might be a smarter move. The downside is that you're out cash right away. The upside of it is that, for those people who may have had it at, let's say, Tesla earlier this year, and they paid their income tax at grant when it was $300. I think now then it's over $1,000. So that's $700 in taxes that they don't have to pay now. So that's a unique rule in the IRS tax code called 83B, and I would encourage everybody to take an inventory of their RSUs when they get them granted, to see if that's something that they might want to do.
Okay, understood. So when you made a comment there mentioning depending on your company, what specifically would it depend on?
I think that there's some risk in that. Like Amazon is the one I mentioned. Amazon's a pretty safe company. If you're if you're going to stick with Amazon, their stock is probably not going to crash. It's going to stay. It may dip a little bit, but by the time it actually does vest 5 years down the road, it's probably going to be higher, even if only moderately, than it was when it was granted to you when it eventually vests. So you might not save yourself as much money as somebody who's, they've got a growth company that just kind of explodes. But the downside of it is, are you going to work at a company for that long, or is that company going to explode? There are some companies that they lose money, or the stock goes down. Then you paid income tax on something that you may not have had to. You might wind up, when it eventually vests, you might wind up paying less if the company's stock goes down. Like IBM would be a good example of that. Not to dunk on my dad was an IBM guy for 31 years. I don't mean to pick on IBM, but I'm just giving an example of something recently that people kind of tangibly grab a hold of.
Okay, understood. Kind of rewinding it back to, maybe someone who, again, they don't know where to start. They see this big intimidating topic, and they say, okay, well, the tax code is ever changing. I believe we just had a recent change in 2017 to the tax code. How can people, at least prepare for these sort of future potential changes we could see in the tax code?
That's a great question. I say diversify your tax situation, because chances are, even if one is changed, not all of them are going to be changed. So your tax situation should look just like your portfolio, in that it's diversified out on when you're going to be taxed.
Okay, and when you talk about a diversified portfolio, what do you, if you were to have a handful of things, or in an ideal scenario, what would you have? What would you start out with?
I would say that, if I'm just starting, kind of thinking, hey, this is something I want to start putting money towards, and I'm working for a company, the first thing I'm going to do is see if they have a 401k, and if they're contributing, because I always encourage people, if they don't have enough money to invest with me, but they're contributing their 401k, that's what they need to do. The 401k, if they're contributing their 401k, it's free money. The company's giving you free money. You need to take it. Everybody, my spouse, she's not a big believer in retirement. I would say that she's probably the textbook case of somebody who is, I will say, cynical of retirement at this point. But I've made sure, it's like that she contributes to her 401k, because her work matches her contribution. So you're leaving money on the table if you don't do it.
Fair enough. Yeah, I've definitely read a few things online. I've heard a few friends, that are kind of in the same camp as your spouse, talking about, being a bit cynical about retirement. But I find that it's mostly, most of the younger generation that would be inclined to believe that, and they'll follow up and say something like, oh, well, Social Security is going to run out, so we're spending our younger years as young adults paying into it for something that we'll never see to fruition when we're much older. So, what would you tell someone like that?
I think that it's important to realize that, like, every successful person hasn't been cynical, right? Like, I mean, if you look at the great entrepreneurs of our time, at some point they believed that what most people said couldn't be done could be done. And that sounds very fortune cookie, but it's true. I mean, if somebody went back to I think it was 1990, when Jeff Bezos was in his garage and was like, "Hey, in 30 years you're going to be the number one billionaire on Forbes list," he probably would have been shocked out of his shoes. So it's important to realize that if you're going to go somewhere in life, you can't be cynical about it. Otherwise, you're not going to get there.
Absolutely. Absolutely. Yeah, it's it's kind of easy to fall prey to that sort of cynicism, especially when we have so much information, so many different opinions, left and right. And frankly, people are just trying to find out what a good path to take.
Yeah, absolutely.
So I know you'd mentioned Bezos, but who in finance inspires you? Who's that non-cynical guy or gal who you look up to and you think that people could get something out of?
I think you could learn a whole lot from the hustle of Warren Buffett. If you look up and like at this point, I know that the younger generation kind of looks at Warren Buffett. He's kind of an older white guy that people just kind of assume like he now like it, and it's true. Like at this point, he makes money off of having money. He just has that much of it. Um, but like if you look at where he started, like 1,000 years ago, the man went out, picked up newspapers, and just sold them door to door in New York City. Like if you have that kind of hustle to go from selling newspapers to a billionaire, like how can you not admire that kind of go? It's unrealistic. If you got up like every morning at like 4 a.m. and just got like a whole bunch of like wet and kind of freshly printed ink newspapers and just went out as a kid and just was knocking doors and be like, hey, you want to buy a newspaper, mister? You did that enough times to get enough money to buy real estate and then go from there. Like that's an incredible amount of hustle and you got to respect it.
Yeah, absolutely. That'll definitely take you far. And I do like hearing stories and seeing success stories of people like that.
Especially because like Elon Musk is brilliant, right? Like he's like a human computer. He'll probably take us to Mars. Like there's a certain amount of professional skill that he had to have to get to be the billionaire he is. But Warren Buffett sold newspapers. Like everybody can sell a newspaper. So that proves right there. If you can sell a newspaper, you can be a billionaire.
Yeah, absolutely. It's kind of harder to have that sort of long-term vision and thinking, most people would think, okay, well, I'm in this place wherever they are, financially, wherever they're at in their life. It's kind of difficult at times for people to take the blinders off and realize you can ascend further, you can keep going to be something else.
Yeah, absolutely. So,
Anyone else aside from Warren Buffett?
uh, well, I actually really look up to my upline. He's a man named Kevin Douglas, and I look up to him mainly because he was a CPA first. He actually had been a small business owner, and then he sold his business with his partners, and just the amount of numerical configurations that this man can do in his head is just mind-boggling to me. In terms of just arithmetic, I think that like it's like he's like a human calculator, and he's sometimes I'm amazed at the fact that he's just cranking out Excel spreadsheets and like as fast as I can read a line, he's got another one going. But he's always, he's somebody that I work very closely with. We have a lot of the same clients that we work on together. And I think that that's been a great boon to my ability to do what I do, is to have the experience and wisdom coming from somebody like that who has the mental efficiency that he does to process things that quickly and that pragmatically has been an incredible boon to my business, and he's a great value to my clients. But I totally look up to him. Someday I would love to be able, once down the line, once I'm closer to his age and his time in the business, I would love to be able to crank things out as confidently as and efficiently as he can.
Beautiful, beautiful. So what is there anything you read on a daily basis? I love what you were talking about. Successful people not having that sort of cynical attitude. You obviously have people who you look up to. Are there any sort of daily habits or rituals or things that you do that you think people could get something out of?
I would say that, and this is something I read from this is gonna sound cheesy, so just work with me on this. But from Dwayne the Rock Johnson, like way back when I was like a teenager, that he said he like every day he works out and that's his anchor, and then everything else, no matter what happens throughout the day, he's like, okay, I got at least that one thing done, And he said that weathered him through an incredible, like numerous storms whenever he didn't have a job or didn't have a home or whatever, all the way up until now. Then eventually, he has, I don't need to care about anything money. So I think that it's important that's one thing I do as well. I find one thing in the day, that's my anchor. And as long as I get that done, even though I'm not saying I don't worry about anything else, but the things that happen, I'm able to deal with them because I was like, I already got that one other thing done. I accomplished something for today. I don't know if you've heard that there is a speech done for UT where I believe it was a military veteran. He stood up and he said that the first thing he did every morning was he made his bed. And
Yeah.
Yeah. So it's a very similar concept like that. Like, get the first thing done. No, it doesn't have to be work related. As a matter of fact, I would encourage that it's not work related. Maybe it's alone time. Maybe you want to go take a walk, or maybe it's making yourself. I have a guy that who works out of our office. His thing is he always makes himself like a bomb breakfast. He's like, if I go to sleep the night before and I think to myself, man, I'm gonna wake up and I'm gonna have this awesome full breakfast. Like, it makes me look forward to getting up, and that was rather profound to me at the time because you don't really think about it. You go to sleep during a weekday and you think, oh, I got to get up, and the burn starts again. But if you like look forward to getting up, you have something that can rock and anchor you in. Everything else becomes more manageable from that.
Absolutely. Yeah, I can definitely get behind that. I mean, especially, the first part you mentioned was, Dwayne "The Rock" Johnson basically suggesting that, once you have that first feeling of discomfort, the first thing in the morning or at some part in your day, everything else, you're almost able to manage it better.
Right. Absolutely.
Yeah.
And the other thing I would say is I would encourage people to you want to surround yourself with other people that are at least in the right mental space and successful going forward. So I believe there's an article that came out, and I'm not sure exactly who did it, but that the 5 to 7 people that you surround yourself with, your friends, are going to your income is going to average out. So you want to surround yourself with successful people. You want to surround yourself with positive voices. Not yes men, not yeah, you can do whatever you want, but people who are doing and making the right decisions to advance themselves as well. So I know that one source of a lot of positive information and negative information is Twitter. Twitter is kind of like it's kind of like trying to take a drink of water out of a fire hydrant. It can just be a lot. But there's a lot of good accounts you can follow on there that are just kind of not work or professional related, but it's kind of like, okay, make this habit happen, get one good thing done today, or it breaks it down, it segments it enough to where you can kind of digest it in really small tangible amounts. When you wake up, you look at this stream and you're like, okay, I can do that today, let me do that. Or it gives you a positive outlook for the day, or it might be a quote or a story. I'm a big story guy. There are accounts I follow from U.S. military veterans, and reading about like a really cool, I guess we'll say like virtuous crusade or quest. And I'll be like, man, if they can do that, I can do whatever I got to do today, because that was really cool. That was valiant.
Yeah, absolutely.
So.
Yeah, that's definitely important too. Kind of how we mentioned before with the cynicism, and frankly, just kind of almost this information overload. It's almost overwhelming. Because if you were to tell me, hey Aaron, I have a bunch of neat things to tell you about finance, I would say, okay, fine, but guess what I looked at on YouTube? I spend 2.5 minutes on how to pay off your credit cards, and then I spend 3.5 minutes on some other financial video. It's almost kind of and before you know it, you have 4 different tabs open and you can't even repeat back what you just watched.
Exactly.
So that's why it's definitely good to have someone like yourself in your corner, having those experienced people to steer you the right way.
Yeah, exactly that.
Yeah, well, David, is there anything else that you haven't said that you would like to say, or anything you really just want to hit home?
I think the last thing I want to say is that, when it comes to talking to a financial professional, just kind of three bullet points I want to hit on. First is that, you want to make sure, especially if you're just starting out, nobody should be charging you for time. Nobody should be hitting a timer once you start speaking, and you're accruing debt before you ever find out how to solve a problem, especially when you're starting out. The next thing I would like to say to people is that, not all financial companies are created equal, even though they might advertise a lot of the same things. If you go to Edward Jones and if you go to Fidelity to set up an IRA, you're going to get two different things. One time you're going to get somebody who's going to walk you through it, ask you what you want. The next time you're going to get somebody that's just, okay, well, you have this asset allocation to pick from. Go. So you want to make sure that you build a relationship with your financial professional. You want to make sure that they're there and easily able to reach, and a lot of them are. And don't think that the other company is evil just because they're not. Everybody kind of fits in their own lane. So you just want to make sure that you can navigate those lanes correctly. And then the third one I would like to touch on is really just that when you're looking up things, you mentioned YouTube, Robinhood, E-Trade. Those are great in that they've brought the ability to invest and the know-how to invest to middle-income families. The trick, I would say, is it can bring some false confidence. There's Investopedia. And Investopedia is just like Wikipedia when it comes to somebody asking for peer-reviewed sources, right? So it's great in that it's a generalized knowledge of what to look for, but products and services are entirely company specific, and their ability and things they can do are company specific. And so I would say don't fall into the trap of thinking that you're an expert after watching some YouTube videos versus somebody who professionally does this for a living.
Absolutely. Absolutely.
So, but that's all I got.
Okay. No, very well said, David. I really enjoyed that. Enjoyed your presentation, and you really got me thinking in a lot of different ways, because it's easy to, kind of block it out and say, okay, well, I know everything there is to know about this, or I know nothing about this, so I'm not even going to try. But you put it in a pretty clear and digestible way, and it's been a pleasure having you.
Yeah, thank you again, Aaron, and I look forward to working with you down the line. So,
Absolutely. Thanks a lot, David. Take care.
you too, sir. Bye bye.